more credit to me in that. We already had a I think so.
Okay, welcome everyone. Still raining out there?
Nope.
We need the rain. I was telling the first class before you guys, just perfect days to have tax class, right? Not 72 and sunny days. Okay. Okay, so just a reminder where we are. We're talking about transfers to a corporation. So we're either have a new corporation we're starting, we need to get assets into it, or we have a different form of business and we're trying to convert that business into a corporation, which similarly involves a transfer of assets into the corporation. So section 351 is our seminal guidance on how to do that on a non-taxable basis. And we talked about on Monday the first requirement, one or more shareholders must transfer property to the corporation. Property is very broad. One thing to keep in mind there, services do not count. You cannot provide services to the corporation. You get compensated with stock and do that on a non-taxable basis. Effectively, the stock that you receive in payment for your services, you get paid for services at tax point. Okay, so we're going to pick up with the second and third requirements here. So the second requirement is that transferring shareholders must receive stock in the transferee corporation in exchange for property transfer. Okay, so we're looking at transfers to a corporation in exchange for stock. If I receive anything other than stock, I have a taxable event that I have to deal with. So the type of stock doesn't matter. It's flexible, so it can be common stock, it can be preferred stock, it can be voting stock, it can be non-voting stock. So we don't really care about what type of stock it is, it just has to be stock. When I have stock and other non-stock property that are received by the transferring shareholders, only the portion of property exchanged for stock has a chance to qualify for tax deferral. Right? The other property is not going to fit in the three requirements that we have here. And the general rule is to transfer the gain realized is recognized unless we meet the three requirements. If I'm not received for stock, or if I'm not receiving stock, then that's a problem. Okay? Interestingly, the contribution from a shareholder to its wholly owned, so when I say wholly owned, 100% owned subsidiary, 100% owned corporation. So think of a founder, think of a large organization where you have lower tier corporations where second tier corporation owned 100% of third tier corporation, right? So that wholly owned nature. If I do a contribution from that wholly owned that owner that wholly owns the corporation, and I do not receive any stock in exchange, you would say, oh, you must receive stock, right? Must is a pretty strong word, in order for it to be non-taxable. Well, here we have something that is called the meaningless gesture doctrine. That means if I own 100% of the subsidiary and I contribute additional assets to it, and I decide not to take back stock, it would be meaningless as a gesture for me to get more stock back. Right? Because before the transaction I own 100%, after the transaction I own 100%, whether I get stock or not. That's why in that specific narrow example, I do not necessarily have to receive shares in exchange. If I own 100 shares of 100 shares, and then they give me 20 shares, and I own 120 of 120 shares, it's 100% before and after. Nothing changed. Okay? But all other fact patterns, I have multiple owners, something like that, I need to receive shares back. Okay. Example 8.2 is Allison.
Suppose in a qualifying section 351 transaction, Jiggy received a 5-year note and Bruce received a value at $60,000 in exchange for contributing machinery. The original cost of the machinery was $70,000 and Jimmy has depreciated to Bruce as $0. Will Jimmy defer recognition of the $60,000 gain realized on the transfer of the machinery? No. Section 351 provides for deferral only when the transfer of property receives stock in return. Jimmy must recognize the entire $60,000.
this was effectively a sale, right? I mean, if I transfer machinery and I get back a note, even though I might be a shareholder in the subsidiary or in the corporation, but I receive a note in this particular transaction, I sold the machinery, right? Because now I have an asset, the note, that's different than what I owned before, and I did not receive stock, so I'm going to fail the second requirement of the 351. Okay. So here, this would be the same analysis as a sale, right? Amount realized, 60,000, adjusted basis. Initial basis less my depreciation. It's a 1231 asset. If she was using this in a trade or business, maybe have some depreciation recapture of the gain, and then the long-term capital grade asset. Okay. Third requirement. This is the one that usually is the most difficult to deal with, especially for an existing corporation. So if it's a new corporation, you're going to meet this requirement. I'll explain in a moment. But for existing corporations, this one can be a little bit more challenging. So immediately after the transferors, so that's plural, must collectively control the corporation to which they transferred the property. Okay? Control is defined as ownership of 80% or more of the total voting power and 80% or more of the total non-voting stock. So just think of it in terms of 80%. 80% of vote and 80% of non-vote. The reason they have the non-vote is that it deals with preferred stock rather than range. So, the important things here is it's immediately after the transfer, so it's not before. After you make the transfer, and you just add everybody together. Collective control of the transferor group. So, it's referred to as the control group. That's who gets to count towards the 80%. Okay, and that must mean immediately after the exchange 80% threshold. What you have to be careful here is of accommodating transferors. So before I get to accommodating transferors, if I have a new corporation that we just formed, and 10 of us, we're going to be the shareholders, and we all dropped in assets, we all get to add all of our ownership together to determine whether we're 80%. And by definition, we're going to be 100%. Okay? Now it's got to be immediately after, so we can't have stragglers coming in later and count our ownership. If I contrast that with an existing corporation and we want to transfer assets to it, the only people that get to count are the control group that is making the transfers in. And if I have existing shareholders who do not participate, that may frustrate your ability to be considered to own 80% after. Right? Because you don't get to count their ownership or transferors. It's immediately after the transfer. Not all transfers for all time. So you get into issues of accommodating transferors, which means, oh, I see that rule. What if I have somebody put in $5? Do I get to count their ownership? Because they're part of the transferor group? That would be considered inappropriate in the eyes of the tax law because you're only making that transfer for purposes of pulling their ownership into your control group. So be aware of accommodating transfers. Somebody who's doing something just so somebody can achieve the 80% threshold. You need to transfer assets into the organization for business use. Okay. So note in the bubble, that's important. Note that the test is the percentage ownership after the exchange, not the amount received in the exchange. So I don't need to receive 80% in the exchange. I just immediately after I have to own 80% of the subsidiary. The reason this rule is there is remember the reason underlying why we are not subjecting this to current taxation. It's because I used to own assets directly. Now I own them indirectly through my ownership in the corporation. They want you to have a significant ownership in the corporation so that you can still have that, the way I like to think of it, the line of sight. You indirectly still own the assets through the corporate stock. So this is just trying to make sure that we have a sufficient amount of corporate stock. Okay, let's do 83. This is Jack.
Alrighty. So for this one, Question is, suppose Ginny joined with Jacob and Alan forming 360 Air and received 25% of the corporation's stock in exchange for services. The stock was valued at $150K. Alan and Jacob received the remaining 75% of the stock in the company in exchange for cash and appreciated property. Will the transfers by Alan and Jacob qualify under 351? The answer to the first one is no, because they only get 75%, and that's only taking into account the exchange for property.
Yeah, so you just, any of these types of questions, just tumble through the three requirements, right? Did I transfer property? Yes, they did, right? These two individuals did. And did they get back stock? Yes, they only got back stock. Did they, Jacob and Al, did they own collectively 80% of the stock immediately after? The answer is no. So they are frustrated in their ability to apply 351, so they will have taxable disposition of the cash and the appreciated property. You don't pay tax on the cash, but you will pay tax on the appreciated property. Right? Okay.
So the next what if is, assume Ginny was hesitant to join with Jacob and Al in the formation of 360 Air. Instead, after 6 months, Ginny changed her mind and received a 10% interest in 360 Air stock in exchange for intangibles that qualified as property under 351. The stock was valued at $60K, and Ginny's adjusted tax basis and the intangibles was zero. Will Ginny's transfer qualify under 351? The answer is no, she does not qualify, because at the time of her contribution, Ginny is the only transfer and does not control 80% or more of 360 Air immediately after the transfer, and must recognize the 60K gain.
So that's the problem of an existing corporation, right? It's already been formed when Jacob and Al made their contribution in, and she comes in 6 months later and decides she wants to make a contribution in. Of getting 25%, she's going to fail the third prong that's required, so she can have a taxable event as well. And the other element that the authors could have put in here is her waiting 6 months does not count towards Jacob and Al's 6 months prior transaction, because immediately after the exchange, Jacob and Al only got 75. You can't count her in the control group 6 months later. Okay? Thank you. So just, this is the one that's the most thorny, is just build your control group, make sure you haven't counted anybody that's making, silly contributions, just so you count their ownership in there. They gotta be meaningful contributions. I think that's 85. So 85 is Logan.
Jacob owns 75% of SCR and Jimmy owns the remaining 25%, along with Al under as a 20% shareholder. Al would transfer appreciated property to SCR in return for stock in SCR valued at $100,000. Will Al recognize any gain realized to the transfer under 351? Answer no. Al does not support SCR immediately after the exchange, taking into account only the stock Al owns in SCR.
And so don't get caught up in anything like good stories or it seems like we should let this person have a non-taxable transaction. It's very objective, right? You gotta meet the three requirements. And immediately after this transaction that Al is doing, he does not meet the third requirement. Taxable transaction, right? This is an exception. It's narrowly written. You have to meet all parts of the exception for you not to have recognition of your realized gain.
What if, suppose Jacob agrees to make an additional property contribution to SCR as Al's transfer in order to qualify
That's bad facts when you read. In order to help Al qualify for his transaction under 351. That's not going to be good facts. You don't want that in an email. You don't want that in a memo that we're doing this so we can get him into the tax deferred.
Jacob's 75% ownership interest in SCR was valued at $300,000 at the time of Al's transfer. Under the IRS mandatory ruling, how much property must Jacob contribute to SCR to have his ownership of stock in SCR transferred in determining if Al qualifies for a bill under 351? The answer is that one accommodation and purchase base previously cited by the IRS, Jacob must contribute property to of existing structures.
So what this is saying, when it says IRS standards for rulings, we do have certain instances where you can go forth to the government and say, here's my facts, I would like you to rule on what the application of the law is to the facts before I do the transaction. Because if we were solely on the self-reporting, you might not know the government disagrees with you until 3+ years later. You'd like to know the bad news first. So this is a way you can go in early and talk to them and get a ruling on the application. And they won't rule on everything because they're resource constrained, even more so now than they've done it in a long period of time. And so there's certain issues that they will rule upon. But what this is saying is their standards for ruling on this particular issue is they want to see 10% or more of the value of your current ownership be contributed. And that's just a way for them to kind of say, okay, that's not really an accommodation. If this investment is $300,000 and this new person is willing to put in $30,000, that's much different than my fact pattern of putting in $5. Now, I know those are maybe too extreme, so there's some gray area in here, but wants to see a meaningful contribution before we'll add that person's ownership into the control group test for whether you need 80% of the. Okay, so those are the requirements I need to have. Transfer of property, I receive stock, and control group has to own greater than 80%. Then I'm going to be in 351, which means the transfer itself can be non-taxable. Okay, so now we're going to spend our time going through, well, what happens at the shareholder level? And then after that, we're going to talk about what happens at the corporate level, right? Two separate taxpayers. Corporations are separate from their owners, so we want to look at what happens at the corporate, at the shareholder level, what happens at the corporate level, because we got two different taxpayers. So we just covered off the taxability. So if the above 351 requirements are met, gain or loss in the property transferred to a corporation is not currently recognized. Realized, you had an exchange, you used to own property, now you own stock, but it's not recognized because you met those three requirements, right? But it's not forgiven, it's not excluded, it's deferred. Okay? We have a realization event, we're choosing not to tax it now. For the reasons we talked about before, the government wants to have, doesn't want the tax law to stand in the way of people getting business activities in corporate form, right? And so we defer this taxation, and that deferred gain or loss is preserved via the tax basis the shareholder takes in the stock received. And when we get to the corporate level side of this, the basis the corporation takes in the assets they receive from the shareholder. Right? That's the seminal backbone of deferral is the way we set tax basis. It's the way the government's protecting themselves from a future event, recognizing that previously deferred realized gain. Okay? So the calculation is in the chart. So I take the cash I contributed. So this is looking from the shareholder going to the corporation. Cash contributed by the shareholder plus the tax basis of any other non-cash property contributed. I don't have to contribute just cash, it can be other property, minus shareholder liabilities that are assumed by the corporation and taken off of the personal balance sheet of the shareholder. That equals your tax basis in the stock receipt. Okay? It doesn't matter if this is Google or if this is the mom and pop grocery store down the street. This is the calculation. Okay? Very simple calculation, but it's all in an effort to preserve the realized but deferred gain on the transaction. And I'll show you how to pressure test whether you got the right basis determination, this calculation by a future sale. So here the shareholder is said to take a substituted basis. You remember from taxation of individuals, we had lots of carryover basis transactions. Remember, carryover basis I like to think of as the basis follows the asset. So if I'm the recipient of the asset, I take a carryover basis. I got the asset from somebody, I take the basis somebody else had, and that's my basis. Carries over with the asset. This is different. Substituted basis means I I take the tax basis in the property transferred is substituted for the tax basis in the stock received. So I'm taking the basis I had in one asset and I'm applying it to the new asset that I own. Technically, that's called substituted basis. If you go into tax, this is probably the most common misuse of the terms. Everyone calls it carryover basis in both situations, even though technically it's not carryover basis. But I want you to kind of just understand when the examples use the word substituted basis, what they're talking about. And that's because that's the rule here. Is I don't take the basis that comes from somebody else. I take the basis from one asset and I apply it to another asset, and that's called substituted basis. I'll show you in the examples a good check to make sure you have the right basis assigned to the stock is a hypothetical immediate sale of the stock for its fair market value should result in the shareholder recognition of gain equal to the realized gain that was deferred. If you just do that extra step while you're in the facts and say, okay, did I get the right basis? Because this looks like a pretty messy calculation and I don't have messy facts. But did I get it right? Think about what is the stock worth immediately after I do the contribution. Well, what if I went out and sold that for cash? So I said amount realized for that number compared to the basis I think I got right. That's going to give me gain or loss. Is that what was deferred in the transaction? If that is, then I got the right basis. Okay. Let's start with this example, 8.6. The first part is phase.
As part of the formation of 360 Air, Al transferred inventory, a building, and a land to the corporation in return for 50% of the corporation stock. So that is 50 shares. The property transferred to the corporation had the following fair market values and adjusted tax basis. Inventories FMV was $25,000, adjusted tax basis $15,000, building FMV was $150,000, adjusted tax basis $60,000, land $200,000 FMV, and the adjusted tax basis was $100,000. So the total fair market value of the transaction was $375,000, and the adjusted tax basis on it was $175,000.
So that's what's at stake, right? There was a transfer of appreciated property at a built-in gain of $200,000. The question you're answering is that realized gain on this contribution to a corporation, is it recognized or is it not? And then I have to understand the basis implications on whether it is taxable or not.
Now, in addition to that, the corporation assumed a mortgage of $75,000 attached to the building and land. The fair market value of the 360 Air stock Al received in the exchange was $300,000. Al realizes a gain of $200,000 on the transfer, computed as follows. Deducting the mortgage assumed by 360 Air of $75,000, adding the mortgage assumed by 360 Air.
Yeah, so I think just to pause you there, you got to really just slow down and think about the facts, right? So this was a liability that Al had associated with the land and the building. He contributed the land and the building, the corporation took on the liability. So think about Al. Al no longer liable for that $75,000, so that's a good thing, right? So corporation, by agreeing to take on that liability, is going to issue shares that are for assets worth $375, subtract the 75 from it, right? Because the net value the corporation took on was gross assets of $375, but subject to a liability of $75. So any corporation is only going to issue you $300,000 of stock, right? Okay.
Then the amount realized is $375,000. Subtracting the adjusted tax basis of the property transfer, $175,000. Al gains $200,000.
And so that calculation is the normal amount realized calculation, the first three parts, right? the fair market value of what I receive and any liability assumed by, quote, transferee. Right, in this instance, the transferee is the corporation, so that's value received. It's no different than if the company issued me 375,000 worth of shares and I use 75,000 of those shares to pay off the debt. Right, so that's why it's amount raised. Okay.
Now, assuming Al meets the requirements under section 351, for the $200,000 gain realized, what is his tax basis in the 50 shares of 360 Air he receives in the exchange?
So here they're not asking you whether 351 applies, they say assume, but he only received 50 shares, so the question I would have is, was he the sole owner, or were there other control group members that got him to a greater than 80%? But here we're just gonna assume that he met all three of those requirements, so we're in a tax deferred situation.
So the answer here is $100,000. Al's tax basis in the stock must reflect the gain he defers in the exchange. Al computes his tax basis in the stock as follows. By subtracting the mortgage assumed by 360 Air of $75,000 from the adjusted tax basis of his property contributed, which was $175,000, he gets a tax basis of $100,000.
So there, if I apply my formula, I take cash contributed, I didn't do, that was 0, plus tax basis of other property contributed, that's 175, and I subtract out the liability assumed by the corporation, that gets me down to 100. The reason the liability is subtracted is because I no longer have that investment in the property, right? So my tax basis has to go down by virtue of that liability assumption. And that check computation that we're going to go through at the end is, if you didn't realize that, or if you didn't remember that rule, or that seems kind of weird to get that right, why is it 100 and not 175? The next statement will help you get some comfort.
Now, if Al subsequently were to sell his 360 Air stock for its fair market value of $300,000,
Why is it 300? Because the corporation decided to assume a liability of 75, so they're going to get 375 of value contributed. They're only going to issue 300 of property, right? Any transferee, that's all they're going to give you. So that's why the value, you got the value right at 300. Okay, now we're going to test it by the basis.
he would recognize a capital gain of $200,000 that he gets from deducting his tax basis from its fair market value, an amount equal to the gain he deferred previously.
Yeah, so if our 100,000 was right, then I've got to get to 200,000 of gain recognized. Does that equal the gain I deferred from the transaction? And the answer is yes, because I didn't recognize any gain on the transaction, and I started with a built-in gain of $200,000 in the property. So that's the day of reckoning, if you will. Just think about, what if I immediately sold this stock? What would be the results? If you get anything other than $200,000 gain, you didn't do the basis calculation. Okay, perfect. Thank you. That was a long one. Okay, 8.6. Simran.
Assume Al received shares of stocks for $375,000 because 360 Air did not assume the mortgage on the
So they're gonna have to give you value. So he's giving gross assets worth 375, so they're gonna give you stock worth 375.
Yeah. So we're being asked what's Al's tax basis in the shares of 360 Air stock received in exchange. The answer is $175,000. That's because to calculate the tax basis, you do the adjusted tax basis of the property contributed, subtracted by the mortgage assumed. Since the mortgage assumed is 0, that's where we get the $175,000 from. And then note that if Al subsequently were to sell his 360 Air stock for its fair market value of $375,000, we would recognize a capital gain of $200,000 because it's the $375,000 minus the $175,000, so that tax basis.
Yeah, so that's the built-in gain that he had at the beginning. Right? So we have to crystallize that again. And if you thought about, well, is my 175 correct? Well, Demon immediately detail and see if you get the right answer.
Assume Al did not meet the requirements under Rule 351 and was required to recognize the 200,000 gain realized. What is Al's tax basis in the 50 shares of 360 air stock received in exchange? The answer is 300,000. Al's tax basis in the stock equals its fair market value. So if Al subsequently sells his 360 air stock for $300,000, he will not recognize any.
So what's tricky about this, they should have told you, this goes back to the original example that Asia was saying, so there was a liability assumption here. So the value of the stock went from 375 to 300. So at that point in time, it's just a sale. You don't meet the requirements of 351, even though it's to a corporation that you own some parts of, it's still a taxable event. What's your amount realized? That's the value of the stock, that's the proceeds you got, 300. And what was your basis? The basis was 175 in the assets in the prior example at the top. And I recognize that full 200. When I recognize gain, then the value I receive, I have fair market value basis in that. Okay, so my basis becomes 300,000 in the stock because I already paid all the tax. Okay. Okay. So that is the general rule if I just receive stock back in the exchange. So if boot is involved, so remember back to individuals. We did like-kind exchanges. Remember when we did that stuff? We had real estate, and so we were exchanging a piece of real estate for another piece of real estate. And if we met certain requirements, not like 351, but there were requirements, then gain realized was not currently recognized. It wasn't forgiven or excluded, it was deferred. Right? So we had the same basis stuff going on that we had before, substituted basis. Question we had with like-kind exchanges, remember, it's not realistic that one parcel of real estate has the exact value of another piece of real estate. They're going to be different in the real world. And so usually cash had to be involved on one side of the transaction to equate to fair market values. So same thing here. I don't have that cash that I need to equivalent to equal the values, but if I do have cash involved, meaning that there's a transfer to a corporation and I do receive stock back, but I also receive something extra besides stock. That's usually cash, but it can be non-cash as well. We call that boot. That's the extra value that's received. And so that's more of a, not to equate the values like in a like-kind exchange, but that's just the transaction that was done, right? Somebody could say, oh yeah, I'll contribute my property to the corporation, but I want X thousands of dollars in exchange. Well, it's partly non-taxable for the amount of stock received and partly taxable for the amount of, partly non-taxable for the stock received, partly taxable for the non-stock received. Cash again. So, a shareholder who receives non-stock property, referred to as boot, in addition to stock received, because if I only receive boot, I have a taxable disposition. It's fully taxable, right? That was the last example. This is just when I have some stock, so I count, and I'm going to meet the requirements of 351, but I just have some extra non-stock involved. So here the rule is I recognize gain, but not loss, equal to the lesser of gain realized or the fair market value of the boot received. This is the same rule that we dealt with in like-kind exchanges. So lesser of gain realized or fair market value of boot received. Okay? So we just got to commit that to memory or write that down in our notes. We're going to go through that in examples, but gain realized or fair market value of boot received, we take the lesser of that, that's the amount we recognize. Boot is allocated to each contributed asset according to the relative fair market values. So this is just saying I can't cherry pick the assets that go in for cash and the assets that go in for stock. I have to spread the boot across all of the properties. And I'm going to do that in the relative fair market values. Okay? That keeps a taxpayer from saying, oh, I want to sell my high basis assets and contribute my low basis assets that I have a big gain in. government makes us spread the boot across the assets, so I recognize something on every asset. The character of any gain recognized is determined by the character of the asset transferred, the same determination as if the asset were sold. Now remember, back in individuals, we did the amount of the gain, amount realized less adjusted basis is gain, then I had to characterize it, right? That's the second step. And why am I characterizing that? Because is it ordinary or is it capital? So here, if I recognize gain across multiple, so if I have multiple assets, spread the boot across the assets. If I have multiple assets, then each gain that's associated with the assets you'll see in the next example, I have to characterize that based on the asset transfer, right? Characterization is always based on how the asset is used by the transferor, not the asset itself. Remember, land can be a capital asset for one investor and an inventory for a person who deals in land. So it's not the asset itself, it's the use of the asset. So you have to look to see what the character is. Okay. Do this tiny example, 8-7 clock. Lighting or your computer. That's going to be an eye chart.
Yeah. Example 8-7. Suppose R received 40 shares of 360 air stock with a fair market value of $315,000 plus $60,000, and this $60,000 is good, that is cash received in exchange for assets transferred to a corporation. Is a classic example.
So that's how you get to the 375, right? He's transferring 375 of value in. He gets 315 of stock back and 60 of cash. Everything's got to equal, right? The value. So I just like to always try to make sure I got the transaction right in my head. Is who gives what and are the values equal?
So he receives this consideration in return for inventory, a building, and land used in his business, and transferred to the corporation in a qualifying Section 351 exchange. The property transferred to the corporation had the following fair market values and adjusted basis. So you can look at the table for the fair market values and the basis. But take note of the 375K for the fair market value and the adjusted tax basis. So the question, what amount of gain does R recognize on receipt of the 60,000 boot, and what is its character? That is ordinary income or Section 1231 gain?
So the reason that question is answered is because this is a 351 transaction, but he got something more than just stock, right? You can never transfer an asset and receive cash and likely not have a taxable event, right? Because you separated yourself from the asset, because now you can't look through cash and see the asset anymore, where you can look through the stock and see the asset. So that's the reason why you're having to go through all these calculations.
The answer is the 60K constitutes boot received and causes R to recognize some or all gain realized on each asset in the transfer.
I don't get to cherry pick which assets are for the 60,000 and which ones for the 315 stock. You get across all of them, right?
I'll apportion the 60K of boot to each of the properties transferred to the corporation based on their relative fair market values. So if you look at the two in brackets by the calculation down there, shows the apportioning for each asset. That's the boot. So the 25 over 375 corresponds to the 25 fair market value over the 375 total consolidated fair market value for all the assets.
Just let me make sure everybody's on that. So I spread the 60,000, 4,000 to inventory, 24,000 to building, and 32,000 to land, and that's just based on this calculation up here, the relative fair market values to the total. Okay.
So I'll recognize as gain on each property transferred in an amount equal to the lesser or to the lesser of the gain realized or the fair market value of the boot apportioned to the property. The computation is made for each property separately as follows. So the computation there, we've got the fair market value, starting with inventory, we've got the fair market value of 360 air stock and cash received 25K.
And that's because up here, we know what the fair market value is, right? So we had a value for value exchange, so I know what each amount realized for each asset was. Yep.
Less adjusted tax basis of that inventory asset transferred, which was 15,000. And the gain realized was 10,000. But the boot apportioned, which is 25 over 375 times 60K, that is the apportionment, is 4,000. And the rule states that the gain recognized is the lesser of either one, the gain realized, or the boot apportioned. So in this case, we select the 4,000 because it's the lesser than the boot apportioned. And the same principle applies across building and land. So the amount of gain recognized for each is the lesser of the gain realized or the fair market value of. In this case, for each of them, each of the three assets, the inventory, building, and land, it was the boot.
Yeah, so there's a lot going on in this example. But I effectively recognize all of the boot because once I apportion the boot to each asset, then I do this test here on each asset. Right, so I know what my fair market value of the stock received, that's my amount realized, less my adjusted basis, they give me those facts. So I know my gain realized, I compare that to my boot, I take lesser of. I just do that 3 times, I sum up those 3, that's going to be my 60,000. Right? So really good example, kind of taking you through a whole bunch of stuff that we built on, from dispositions to apportionment of boot around different assets, and then doing the lesser of roll. Okay, thank you. Okay, second part of 8.7 is Matt.
So for this one, we're going to suppose the land has a tax basis of 250,000. With that, we need to the land as follows. So starting with fair market value of 3,000, subtract the adjusted tax base of 250,000, into realized loss of 50,000, and the portion as 32,000.
So let me pause you there. So the fair market value is the same, right? Because the only facts they changed was the tax basis in the land. If I go to the prior facts, my land is still worth 200,000. They adjusted this so that I have a built-in loss in the land, right? But so that 200,000 is the same. The 32,000 is the same because I'm spreading the boot amongst all the assets in relative fair market values, right? So still 200 over 375. I still got the 32,000, but now I'm dealing with built-in loss profit.
So ultimately, no loss is recognized because I can't recognize any realized losses. Food only causes gains realized. Gains realized to be recognized. Ultimately, I recognize total gain of 20,000 for receipt of the building, inventory, and the deferred recognition of 70,000 gain realized for receipt of the building inventory, and all the 50,000 loss realized for receipt.
Yeah, so just making sure we're all on the same page on the application of this test. The amount of gain realized, the lesser of gain realized, are fair market value. Since it's the lesser of, my gain realized was 0. I can't get below 0, right? So that's my lesser of. So that's why I don't have any recognition here. But what happened on these other 2 assets still occurs, right? I recognize 4,000 on the inventory and 24,000 on the building, which should be these numbers. And I defer the 72,000 of gain realized from receipt of the building inventory. That's the excess of gain realized over boot in the prior transaction, or in the prior calculation. Okay, so lots going on in example 8.7, but I think if you spend some time on 8.7, then you're going to have the apportionment of boot and the lesser rule down. Okay, thank you. Okay. Because any boot received by the taxpayer takes a tax basis equal to its fair market value, the tax basis in the stock received must then be adjusted to account for the boot received. So whenever I get boot, so in that example, he was getting $60,000 in cash. I have basis in the $60,000 in cash, right? And so in order to do that, I have to adjust the basis in the stock received by the boot implications in the transaction. So I'm taking that prior calculation I had before and I'm adding these two rows to it. So if you wanted to have a very comprehensive shareholder level basis determination in the transferred stock, this is your calculation. There can't be anything else going on inside of it. Because if you didn't have boot, then these yellow filled rows would be 0 and 0. Okay? But it would make you think about whether, did I only receive stock or did I receive some non-stock things? Okay, so I'm going to take the cash contributed, tax basis of other property contributed, that's what we talked about earlier, and then I'm going to make adjustments for my boot in the transaction. Any gain recognized on the transfer, so the transferor, if I recognize gain, my basis in the stock goes up, my basis goes down in the stock received equal to the fair market value of the boot received. Assign that to the boot. And the reason I get basis increase for the gain recognized is because whenever somebody pays tax, somebody gets gain. Because there's been tax paid. And so that's why I have an increase on the tax basis. And then the liabilities assumed are from the earlier calculation. That will give me my tax basis in the stock receipt. So let's do 8.8, which is Lauren.
So what is our stock basis? And the answer is $135,000. And to get that, you start with the adjusted tax basis of $175,000 plus the gain recognized on the exchange of $60,000 plus the fair market value of the boot receipt of $60,000, and you get the tax basis.
So we're going back to the facts that Claude presented. We recognize the full amount of the $60,000 because the lesser of boot received or gain realized, the boot received allocated each piece of property was the lesser of. So we recognize all of the boot. So you're just going to have a up 60, down 60 in the calculation. And I think it's good just to do that because you, if you did the example that Matt then did, it's not going to be up and down by the same number, right? Your boot is the 60,000, but you didn't recognize all the gain. Right? So you just got to be methodical in applying the basis rule. Now walk us through the immediate sale check.
So it also
So let's just do the 315. Why is the 315 the right number? Well, go back to Claude's example. I transferred value of 375 to the corporation. I received 60,000 of cash and stock. For it to be an arm's length transaction, I had to get 315,000 value of stock. So my fair market value and my amount realized on this hypothetical immediate sale would be 315. Right? Okay.
So then you'll recognize $140,000, which is the 315 minus the 175.
So that 175, if I wanted to see if I had the right basis, so I would, if I had 315 for amount realized and my basis of 175 was correct, I would give me a gain of 140. Is the 140 correct? Go back to the example. I had a $200,000 built-in gain. That was my latent gain in the property contributed. I recognized 60 of that. So I only had 140 that was deferred. And Lauren's example, I would have triggered the remaining 140 on an immediate sale. That tells me my 175 is correct, the right basis. Okay? So I think looking at it that way just gives you a complete picture, right? I like all the parts got to fit. I tell my daughter it's math. At the end of the day, the math has to work, right? So just spend a little extra time, and I'd ask you to think about doing that on an exam if you want to make sure that get the basis right. What would be the value of this if I turn around and sold this stock to a third person? Test your basis against it. Is that gain now recognized? Is that equal my previously deferred gain on the okay? Okay. So this next topic is about boot as well, and whether a liability assumed by a corporation should constitute boot. Right, we talked about boot. Clearly cash coming from the corporation to the transferor. Shareholder is boot, other non-cash property. The question we're going to explore here is, should the assumption of a shareholder level liability by the corporation constitute boot? If you just step back from it, I would say, sure looks like boot to me, because it's no different than if I send you cash from corporation to shareholder and you use that cash to pay off debt. Right? Instead of doing that, just assume the debt. That seems like the same thing. Right? So instead of, in Claude's example, you give me $60,000, you take a $60,000 liability off my books. That seems like I'm $60,000 better off. Seems no different than if you gave me $60,000 and I paid off the bank. Right? So that's what we're going to test here. So when a business assets are transferred to a corporation, they may assume outstanding liabilities, and they're usually related to the business assets, right? That example that we went through, I think Matt's example was when there was a lot. No, that was Simran's example when there was a liability assumed. But if there was a liability assumed with the asset, let me get my thoughts here. It's right. Their facts were saying it was tied to the land and the building, right? So what happened was they borrowed, Al, I think, borrowed money to buy those assets, right? So there was a causal connection between the debt and the assets. So it's very common for someone, just like when we were talking about real estate transactions and individuals, or I sell the asset, you take the liability, right? Don't pay me for the gross asset and make me go pay the bank. Just take the debt that's associated with liability. So that could be existing accounts payable, right? That are, like if you're running a sole proprietorship and you have accounts payable as part of your business, so you have expenses that you owe the vendor for, you might contribute all of that to the corporation, and the corporation takes over those outstanding accounts payable. Or it could be notes payable, like in the example relating to property, plant, and equipment. But assets and liabilities following the assets are going down in the corporation. So, in determining whether the assumption of such liabilities should be treated as boot, you would normally think that is the case because the shareholder receives something of value apart from the stock of the corporation. I.e., the value I received was you assuming my liability. So, if it's an individual contributor, which you've been dealing with in these examples, I like to think of that as you're making me better off by taking that liability off my personal balance. My net worth went up. Okay. The general rule here is that a corporation's assumption of shareholder liabilities associated with property transferred to the corporation does not constitute boot received by the shareholder. So even though I started off with it smells and it looks like boot because its value effectively transferred to the shareholder by removing the liability from their personal balance sheet, the general rule is we are not going to consider that boot. Okay? I think that's good because now we're going to talk about exceptions to the general rule, where it does count as boot. So the first one shouldn't be a surprise, but if it's a tax avoidance transaction, so the debt is moving from the shareholder to the corporation in a tax avoidance transaction. Talk about what that is, then we will count that as boot. We'll make the shareholder go through those calculations of potentially recognized gain to the extent of the lesser of gain realized or the boot received. So what is a tax avoidance transaction? So if any liabilities assumed by a corporation are contributed with the purpose of avoiding federal income tax, or if there is no corporate business purpose for the liability assumption, all of the liabilities are in fact treated as boot to the shareholder. So we do exactly what we just spent the last 10, 15 minutes on, and it's considered just like cash, right? Because all boot is considered similar. So the avoidance of federal income tax may be present where the corporation assumes debt created by the shareholder immediately prior to the contribution of the encumbered assets. Since the shareholder keeps the borrowed proceeds and the corporation is required to repay the debt, there is equivalent to the corporation transferring boot to the shareholder for the asset received. Again, I like to think about, well, why is this the rule? So, I think premised in the prior example, Al had land and building and a liability associated with that. So that tells me he borrowed the money to buy those assets at some point in time. So there's a causal connection between this. If instead Al bought those with cash, and right before the contribution to the corporation said, I'm going to borrow against those assets. So I go out to the bank and I say, lend me money secured by these assets. I get cash proceeds, right, from the borrowing. And then I transfer the assets and the liability to the subsidiary. It looks like I cashed out, right, because I got cash at the end of the day. That's no different than if I did get boot in the transaction, right? The tax avoidance purpose, look for bad facts, right? Whenever there's a court case out there where there's a tax avoidance purpose, I guarantee you there's some bad facts in there, right? That disconnect of when the assets were acquired and the liability and the proximity of it incurring the liability to the asset contribution, those are the bad facts here. That just looks like you're just trying to manage the results to your best ability, and that's not going to work for purposes. So that would be considered the avoidance of federal income tax because I'm getting cash and I hadn't paid tax on the transaction. And there is the other way we can have a tax avoidance transaction is the lack of corporate business purpose. That's typically when shareholders have the corporation assume their personal liabilities. So it doesn't have any connection with the assets that go in. Okay, like, oh, take my loan for my car. I bought a new car. But the car, I keep the car, but you take the liability, right? That's a tax avoidance purpose. Again, the shareholder would have kept the asset but not have the liability. That's what we're going to treat the liability assumption as a boot. Okay, let's do 9. Joseph?
Suppose that when forming 360 here, Jacob transferred a parcel of land in exchange for 30% of the corporation stock valued at $80,000. The land's fair market value was $100,000 and its tax basis to Jacob was $35,000 and the land was subject to a $200,000 mortgage that 360 heir assumed on the transfer. Jacob borrowed the $20,000 from a bank using the land as collateral shortly before transferring the land to 360 heir.
So the bad facts, the shortly before the transfer. Right? He's trying to monetize that asset by levering the asset, keeping the proceeds, and then having somebody take the asset and the liability, but I keep the cash.
Jacob used the mortgage proceeds to pay for a new car.
Even a worse fact, right? You use the cash to go buy a new car. Okay.
Assuming the transfer qualifies under Section 351 and that the mortgage has a tax avoidance purpose. What gain or loss does Jacob recognize on the transfer? So the answer would be $200,000 gain recognized. It's like Jacob realized a $65,000 gain on the land transfer, which is $100,000 fair market value minus the $35,000 basis. And because the mortgage has a tax avoidance purpose, and the 20,000 relief of that is treated as boot received by Jacob on the exchange. Consequently, he must recognize gain in the amount of the lesser of the $65,000 realized gain or the $20,000 boot receipt.
So the way to approach this, first of all, is I like to write, graphically depict the transaction. Like, here's the shareholder, here's the assets that land, liabilities. Just make sure I got all that clear because I think it's hard sometimes to parse through when somebody just gives you the facts on a piece of paper. You're on a timed exam. So once you do that, then you know you have a liability assumption. The general rule is it's not included, except for if there's tax avoidance purpose here, and they're telling you this is a tax avoidance purpose, bad facts. Then what happens? Well, now it's boot. You don't have to do anything else more than now, what do I do with boot? And that's the analysis you just went through. We just treat it as if it were cash in the transaction, the amount of the liability assumed. And that's the lesser of gain realized or fair market value of the boot.
Supposing the liability did not have a tax avoidance purpose, what gain would Jacob recognize on the exchange? And the answer would be 0 because the liability is not considered to be boot. Jacob is allowed to defer the entire gain realized on the exchange.
So that's going back to the general rule, right? If we have a liability assumption and does not run afoul of a tax avoidance transaction, then it's not going to be considered boot in the transaction. So there won't be gain recognition. Okay, thank you. Subject to one more exception. Yes, Art.
If shareholder transfers business assets and also personal assets at the same time, is that bifurcated or is treated all as both?
That's an interesting question. So, what's giving me a little bit of pause is, should the corporation be a part of that second part of that transaction, the part that says you were transferring personal assets in? And I think you would have that overriding kind of business limitation to the transaction, especially if you were doing the contribution and I was part of that contribution. I'd be like, we don't want your used car, no offense, Arthur, to be contributed to the corporation, because what does the corporation need to do with that? So that's your personal stuff. So I would argue, keep that out of the transaction. Let's only do the business assets. What does the corporation need to do its business? But as you know, you can do a corporation and be the 100% owner. So you're not going to have a debate with anybody but yourself. So if you decide to put in personal assets, I would think that you can do that, because the 3 requirements, and again, I just go back to the black letter of the law. There's 3 requirements to do a 351 transaction, and it doesn't say anything about, oh, there's got to be a, the corporation's got to use the asset in its business. So I think you could probably do that under the confines of 351. If you had liabilities associated with your personal assets, I think it would get spread amongst all the assets in the example that Claude did. So I don't think it would be bifurcated, oh, it's only on the personal assets and not the corporate assets. I think it would get spread across all of the assets. So you'd have a deemed disposition of a portion of each one of the assets, of which you'd have to do the lesser of gain realized or boot received computation.
Exception, what's the threshold of saying that you took liability? They're like a specific.
No, it's a very subjective determination. So tax avoidance purpose, by definition, if you see something like that, that's a subjective nature. And so you could have a dispute where the taxpayers are like, oh, there was no tax avoidance purpose, but the government can disagree. You can go to court, the judge can maybe agree or disagree with either party. So it's just a subjective determination. But I'm just posing to you bad facts of levering an asset right before the transaction to contribute down to the corporation is not going to be a good fact. And I think most judges would look at that and say, that looks like you're cashing out of that investment because you separated the cash from the liability. You kept the cash from the borrowing. Liability was assumed by another party. So those are just inherently difficult when you have subjective criteria. Okay, so general rule, liability assumption is not boot. We have an exception for tax avoidance purpose. We also have an exception for liabilities in excess of tax basis. Okay, so even in cases where liabilities assumed by the corporation are not boot in the transfer, because the assumption does not implicate tax avoidance or lack of business purpose, the shareholder is nonetheless required to recognize gain to the extent liabilities assumed by the corporation exceed aggregate tax basis in the assets transferred. So this is just an exception that I have to test for when I have liabilities assumed. I want to pause and make sure, do I have aggregate tax basis that is less than the liabilities assumed? If I do, then I will treat that excess as boot for the liabilities assumed. And the character of any gain is determined by the character of the assets transferred. It's the same example that Claude went through. We spread the boot across the assets, and I look at a disposition of each one of the assets. The characterization of that is going to be based on the use of that asset. Okay, let's do this example. So 8, 10, I believe this has a couple of parts. So Flora, you have the first one, and then Lauren.
Assume I'll transfer inventory of building and land to later in return for 50% of the corporation stock with a fair market value of $175,000. The corporation will assume a mortgage of $200,000 attached to the land and building. The property transfer have a fair market value and tax rate as follows. So the total adjusted tax basis is $175,000.
So this goes back to our prior examples where I had a built-in gain of 200,000, right? So I have aggregate value greater than aggregate tax basis. Okay.
Since the amount of liability exceeds the aggregate tax basis, the IO is required to recognize the gain. As fair market value of 330 Air stock received by $175,000 plus mortgage $200,000. The total amount realized is $375,000.
Let me pause you there. So that's I transferred assets with a value of 375. They assumed, the corporation assumed a liability of 200, so they're only going to give me a stock worth 175 to equal the 375 that they received. That's the total value received by the shareholder, right?
And then minus the adjusted tax basis is $175,000. So the total gain realized is $200,000.
Which equals my built-in gain in the top calculation, top gain.
And the question is, what amount gain, if any, does IO recognize for assuming the requirements of 351? The answer is $25,000. In excess of the mortgage assumed by 330 Air over the aggregate adjusted tax basis of the property IO transferred to the corporation. IO defers gain of $175,000. The character of the $25,000 gain is determined by allocating the gain to the contributed assets and treating the gain in accordance with the character of the
Go through the.
For example, in this case, 6.67% of the $25,000 gain will be allocated to the inventory and tax and ordinary income.
Yeah, so what we're looking at here, you need to compare whether you have liabilities in excess of tax basis. You look at the amount of the mortgage assumed, 200,000, and you look at the aggregate tax basis of the assets going into the corporation. So here we have excess of 25,000. So that will be considered boot in the transaction because it runs afoul of this exception. And that 25,000 gets spread. What this example is down here, 25 over 375 is associated with the inventory. And that means that 6.67% of that $25,000 gain, because this delta is 25K, is going to relate to the inventory. If I sold inventory for a $25,000 gain, that's gonna be just ordinary income, right? So, this is just a final test that you have to do, liabilities in excess of basis. If liabilities are assumed, any incremental excess is gonna be considered. Okay, thank you. Right, Lauren, second part?
Okay, so what is Al's tax basis in the 360 air stock? The answer is 0, which is found by taking the adjusted tax basis of property contributed of $175,000.
That's from the prior table at the top, right?
Then you add the gain recognized on the exchange of $25,000.
That was because I had 25,000 excess of liabilities assumed over a aggregate tax basis.
And then subtract the mortgage assumed by 360 air of $200,000. And you get the tax basis of stock received of $0.
So that's just applying that expanded table that I mentioned. But if I did that, I would say, oh, that seems weird. Tax basis is 0. Is that right? So then you can test that in the next section.
So if Al sold his 360 air stock for $175,000, its current fair market value, because 360 air transferred value to Al of $200,000 in form of liability assumption in exchange for assets with a fair market value of $375,000.
Yeah. So how did I pay for the 375 as the corporation? I gave. I assume the liability of the transferor of 200,000, so it means I have to issue shares worth 175 to get the 375.
He would recognize a gain of $175,000, an amount equal to the gain he deferred in the exchange. So the 200 gain realized less the 25 gain recognized equals 175,000.
Yeah, so there's a lot going on in this example, but you can work your way through that check computation. I think that gives you some comfort that, yeah, even though I put a 0 in there, I got the right number. Because I had 200,000 of gain realized, of which I recognized 25 of that due to that last rule we talked about. I had liabilities assumed greater than tax basis, aggregate tax basis of 25. So I recognized 25 of that, so I had 175 that was still hanging out there deferred. I sold stock for 175, 0 basis. That's okay. Thank you. Okay. So the corporate level tax consequences. So a corporation that issues its own stock in exchange for property never recognizes gain or loss. Okay. So we did the shareholder side. Shareholder, is it taxable or not? That's governed by the 351(3) requirement. Then I got to do that tax basis stuff. And I think if you focus on this last, larger expanded table, I will always get you the right tax basis. Think about whether you know the check computation. So that's the shareholder side. So now on the corporate level side, because we have two taxpayers, right? So we're done with the shareholder, we're looking at the corporation. So first think about, in a 351, does a corporation have a taxable event? The answer is no. We have a blanket rule that whenever a shareholder issues shares in exchange for property, they do not recognize gain or loss. Then we have tax basis rules on the corporate side. And this is going to be the carryover basis rule. So if I meet the requirements of 351, okay, that means that the overall transaction is non-taxable. I meet those three requirements. The recipient corporation takes the tax basis in the property received equal to the tax basis the shareholder had in the property. This is the carryover basis. Right? The assets came from the shareholder to the corporation. I took the shareholder's basis with the assets I took. I followed the assets and carried over. So the shareholders take a substituted basis because they had basis in assets, now they have basis in stock. The corporation says, oh, I just got assets, I take a carryover basis equal to those assets. Transaction does not meet the requirements of 351, resulting in the transferring shareholder recognizing gain or loss. The recipient corporation will take a tax basis in the property equal to its fair market value. So in a purely tax-deferred transaction, I take carryover basis in the assets. Right? That preserves the gain in the assets, right? It wasn't recognized at the shareholder level. Now the assets come into the corporation. If I take the same basis, the value hasn't changed. The gain is now preserved inside the corporation. That's the hallmark of deferral, right? Government hasn't deferred, or hasn't forgiven the tax, it's just deferred it and saying now is not the time, but I want to be able to track it in the future. So if the corporation were to go out and sell those assets, then you have corporate level taxable. Okay? So if the transaction does not meet 351 transactions, so the shareholder had a full taxable event contributing it in, then the corporation has full tax basis in the assets, right? Because the gain inherent in the assets was already taxed to the shareholder. I don't need to tax it again. Okay? Nothing else to preserve. Okay? So tax basis, the general rule I want to leave you with, if the shareholder recognizes some gain on the transaction due to the receipt of boot, so there was boot in the transaction, or liabilities assumed by the corporation that further the tax avoidance purpose, lack of business purpose, or exceed the shareholder's tax basis, any of those exceptions where we count liability assumption as being boot in the transaction, the corporation increases its tax basis in each asset by the gain recognized by the shareholder on the transfer of that asset. Okay, so we start off with carryover tax basis. I just say, you shareholder, what was your basis on those assets? That's mine. Oh, you paid tax on some of that? I'm going to incrementally increase my basis in the assets by the tax you paid. Because again, the government already paid the tax on the assets. Okay? That's going to give me my tax basis in the assets. Okay, 812, we'll finish with that. That is Ed.
So for 812, let's return it back to example 87, in which we have received 40 shares of 360 stock with a fair market value of 215K and 60 in return of the transfer of inventory.
So we had cash, so we have food,
Yeah.
right?
Yeah.
And 315.
In return of inventory of building and land to the corporation, qualifying 351 change. The 60K received by AI constitutes food. So this explicitly say that this is the food. Received and causing to recognize gain on the transfer. So according to the previous slide, the total is the shareholder tax basis and assets contributed plus being recognized by shareholder on transfer of assets, which in this case will be 60K. The 60K was allocated to each of the property transferred to the corporation based on the relative fair market value. They are recognized gain on each property transfer in amount equal to the lesser of gain realized or the fair market value of the food allocated to the property.
That was Claude's example. We had 175,000 of adjusted tax basis. I had 60,000 in cash, and I recognized all of that because the food allocated was the lesser of.
And in the chart below, it says that AI tax results from this transaction can be summarized as follows. So in this chart, we saw there's an adjusted tax basis, which is like referring to the previous slide, shareholder tax basis and asset contributed.
That's my carryover basis, so that's my first line in my chart, right? Start with that.
Yeah, and then in the previous slide, we need to add the gain recognized by shareholder on transfer of assets, which is the gain recognized. That is the other line in our chart. And then we calculated by recognizing the lesser of the gain realized or the fair market value.
Yeah, so I put a comment here. If you look at the review comments on the slide, it'll show you that check computation. If I sell the inventory at its fair market value, is 19,000 the right adjusted tax basis, and it'll show you that that's the right number on that because you're going to do the same testing that we just did on all the other transactions. So you can see how I would just, when you go back and review this, I block out enough time to go through all these examples sequentially because they're just building on top of each other. If you come in the middle, it's going to be a little more difficult. Okay, so we'll pick up with this on Monday, and I'll send you a note tomorrow on what we're going to do next month. So, thank you.
I'm not going to pause. Chuck, I'm like my parents are so bad. I want to
No rejection.
I volunteered.
Not power to go.
Actually, I kind of like it. I've already done all my hours. With class that I paid.